Hello guys, so in this video I'm going to be teaching about candlesticks interpretation. So when you open any forex chart, you're definitely going to come across the candlesticks. So it's very important to understand what candlesticks are and what they mean so that you can be able to interpret any forex chart or any forex market. So basically, candlesticks are simply a representation of price behavior within a specified period of time, or rather within a specified time frame. For example, if we look at our chart here, let's assume we're using the 1 hour time frame. It simply means that each candlestick here represents the behavior of price within the last 1 hour. So for example, if this candlestick is green, which in this case green means that the market was buying, it simply shows that within the last 1 hour the market was bullish. Same to this, same to this. When the candlestick is red, it shows that within the past 1 hour the market was bearish. So that's the definition of candlesticks. So just as I've mentioned already, candlesticks are either bullish or bearish. So bullish simply means that the candlestick was buying, meaning price was rising. But if within the specific time period or time frame, the market was dropping or selling, we say the candlestick is bearish. And this is a very good example. So all these candlesticks which are green here are bullish candlesticks. Then we have the red candlesticks which are bearish candlesticks. So if again we assume we're using the 1 hour time frame, it means each candlestick here represents 1 hour. And it also means that within all these number of hours, the market was going up. That's why all the candles are green. On the other hand, the red candlesticks represent that the market is bearish, or rather the price is selling, or the price is dropping. So all these candlesticks here show that price was selling within this number of hours. And just to make it clear, the color of the candlesticks doesn't really matter. The color will simply depend with you as a trader. So you will simply put the color that is most preferable to you. So in this case, the green color represents that the candlesticks are buying or are bullish, and the red color represents that the candlesticks are selling. So let's move to labeling the candlesticks. First of all, a candlestick structure, or rather the structure of a candlestick, has two parts. The first part is the body, the second part is the shadow. So the body simply shows the range between the opening and the closing price for a specific time frame, or rather for a specific time period. So for example, since we're using 1 hour time frame, this body, the body is the part that is filled with the paint, or is filled with this color, as you can see. So the body just shows the range between the opening and the closing price. On the other hand, the shadow shows the highest and the lowest levels that price reached during the specific time frame. So that's the difference between the body and the shadow. So now let's go further and label the candle. I'm going to start with the bullish candlestick. So all candlesticks have the same labeling, which is the open, high, low, and the close. With the bullish candlestick, the open is simply the price at which the market opened within that specific time frame. For example, we are using the 1 hour. So that means at the beginning of the 1 hour, this is exactly where price was. So that is the open. Because the market is buying, the close is where the price was at the end of that time period. So when the 1 hour was closing, this is where the price was. So this is the close. But as you can see, we still have the low and we still have the high. So the low is simply the lowest price point at which the price reached during that specific time period. The high is the opposite. So the high is the highest point which price reached within that specific time frame or that time period. So for example, within the 1 hour, the price opened here, but since we have our low here, it simply means that before this price started buying, it first tried to sell. But as much as it sold, it got to this point and it was rejected. So the price started buying, it went further up, and it got all the way to this high, as you can see. But at the close of the 1 hour, the price had moved back down to this point. So now that is the close. Same case with the bearish candlestick. With the bearish candlestick, we know this time that the price is now moving downward. So the open is where the price opened during this time period. So price opened here. After opening here, price first tried to buy a little bit, but it faced rejection. So because of this rejection, this highest point where price reached during that 1 hour, we call that point the high. But after this rejection, price came back down and it sold. It sold all the way to this point. So this is the lowest point where price sold to within that specific time period, which is 1 hour in this example. But by the time the 1 hour was closing, price had traveled back up a little bit to this point. So we call this point the close. So basically that is how you interpret the candlestick with the open, high, low, and close. So now interpreting these candlesticks. So if you've noticed, these candlesticks have very different behaviors. For example, if you look at this chart here, some candlesticks have long bodies, some have short bodies. Same with the shadows. Some candlesticks, like this one, has a very long shadow as compared to, let's say, a shadow on this candlestick here. So it's this behavior of the candlesticks based on their length, or rather the height of the bodies and the shadows, that we use to interpret the candlesticks. So whenever you see a long body indicates strong price momentum. So it doesn't matter whether the candlestick is bullish or bearish. The most important thing is for you to check the size, or rather the length of the body. So in this case, this candlestick is bullish. So when we have a long body, it simply shows that we have strong buying momentum. And it's very opposite for the bearish candlestick. This candlestick is bearish and it has a long body. So it indicates that we have strong momentum to sell, or rather you can say we have strong selling pressure. So this will help you to also make decisions, because for example, if you've already known that you have strong selling pressure, you wouldn't want to buy in this market, right? Yeah. So if you compare the size, or rather the length of the bodies of the candlesticks, they simply try to show you the behavior. Just as you mentioned, the longer the body, the stronger the price momentum. The shorter the body, the weaker the price momentum. So this candlestick is very bullish, meaning the buyers are very strong because it has a long body. This one has slightly a shorter body as compared to the previous one. So that means that the buyers are a little bit weaker as compared to the buyers at this time. And the more we move to this candlestick, which has a very small body, it indicates that now the market is very less bullish, because now the buyers are being kicked out of the market. So the longer the body of the candlestick, the stronger the price momentum. And the same applies to even the bearish candlesticks. When you look at this candlestick, it's very bearish, but the more we proceed, as their bodies become smaller, the less bearish. So long body represents strong momentum, shorter bodies represent a weaker momentum. Then let's now move to the shadows, because the candlestick has a body and a shadow. So if you remember from the interpretation here, we said, for example, if we use the bullish candlestick, price opened here, it tried to sell, but it faced rejection. So that's the key point. It faced rejection, so it went back up. It bought all the way to this high, but still it faced some rejection there. So by the time the time frame was closing, or this time period was closing, the candlestick had moved back down here. So the shadows simply represent price rejection. That's why price moved down, but it was rejected. Then it left a shadow below and above. It applies both to the bullish and the bearish candlestick. So in other words, shadows represent price rejection. Also, just like the bodies, we also have longer shadows and shorter shadows. So the longer the shadow, the stronger the price rejection. The shorter the shadow, the lesser the price rejection. And this is a very good example. If you take these two candlesticks, all these candlesticks are bullish because they are green, right? That means this candlestick shows that the market bought within this time period, same as this. But this one has a long shadow to its upside. This one has a longer shadow to the downside. So when we have a longer shadow to the upside, Remember, we've already said that long shadows represent strong price rejection. So I don't want you to confuse this concept. Generally, all shadows represent rejection, but the longer the shadow, the stronger the price rejection. So that means if you want to identify a strong price rejection on a chart, don't just focus on any shadow, because if you look at our previous example here, this chart has so many shadows on each candlestick, but it's the longer shadows that matter more, because the longer shadows now show you that the rejection is stronger, so you want to focus on those longer shadows. So back to this candlestick, we have a long shadow to the upside of the candlestick, meaning that this candlestick opened here because it's green, meaning it was buying. It opened here, price moved all the way up to this point, but the buyers became weaker because the sellers pushed the buyers all the way down to this point. So you can imagine price coming from here, moving all the way up, but by the time the time period is closing, the price has gone back down almost close to the entry point. That shows that there is no strength to buy. In other words, the sellers are the ones who are stronger, because the sellers are the ones who pushed the buyers back all the way down here. So based on the side that the shadow has appeared, it will help you to determine whether the rejection is from the buyer or from the sellers. So in this example, it's the buyers who've been rejected by the sellers. And it doesn't mean just because the buyers have been rejected by the sellers, it doesn't give you a signal for you to now take the opposite trade, but it just helps you to interpret the behavior of the market. Then maybe you can wait for further confirmation by using other tools of analysis before you can determine whether the sellers have taken total control, because it's possible that they can be weak for just this time period, but if you check the next candlesticks, they might come back and gain even strength. So the same is applies for this candlestick. This time we have a long shadow, but the long shadow is to the downside. So it simply means because it's green and it's buying, price opened here and price closed here. But before even price closed here, price started to sell. So price sold all the way to this low. But by the time the 1 hour was closing, price had stopped selling, it had been pushed back, and it now turned to become a bullish candle and it closed here. So this one shows you that we have strong rejection to the downside. So that means sellers are being rejected. So such a candlestick will try to show you that buyers are trying to be in control. So basically that is how you interpret candlesticks. So it's very important to understand the interpretation of candlesticks, just as we've seen, because based on their sizes, you can be able to determine whether the momentum is strong or weak, or whether the rejection is strong or weak. And not forgetting this candlestick, it has an equal length of the upside and the downside shadow. So it's a neutral candlestick, just showing that neither the buyers nor the sellers are in control. So two things that we realize about candlesticks. The first thing is that candlesticks will help us to determine the momentum of the market, because if we see long candlesticks, we're able to conclude that the market has momentum. So if the candlesticks are long and they are bullish, we can tell that we have strong buyers. If it's the opposite, we have strong sellers. So that's the first thing, the momentum. The second thing is, if the market is neutral, it means that there is confusion, or rather you can say there is price indecision. So apart from being able to determine momentum, it's also important for you to determine whether the market is in indecision. Because when there is indecision in the market, it means that neither buyers nor sellers are strong. So at this point, you might want to stay out of the market, but at this point, you might want to buy because the buyers are strong. And the opposite for this case. Let's take an example of just a live market right now. This is GBP JPY. Just want to see how practical these concepts are. So let's see if we can spot anything. For example, if you look here, this is a very long candlestick. Remember we said that long body candlestick represents price momentum. Same to this is a long body candlestick. And as you can see, the long body candlestick is bullish. So when it's bullish, we get that the momentum is strong for the buyers. So in this case, if you took a buy trade, you see indeed the market continued pushing up. So this concept isn't just applied independently like that. These are just few examples which worked out perfectly, but it doesn't mean that you just open your chart and you spot any long candlestick and you buy because it's green. No. The more you learn, the more you realize that you have to do something called confluence trading, where you have to apply different concepts before you can validate a signal in the market. So let's look at the opposite candlesticks. This is a red candlestick which is having a very long body, and you see after the long body we expect that the sellers have control and the market indeed dropped. If that candlestick wasn't enough for you, just after one more candlestick we had another long body candlestick, and as you can see, after the long body candlestick the sellers continue to drop. The market played a bit. We also had another long body candlestick, another long body candlestick. So the long body candlestick shows strong sellers in control. And then we've also talked of the long shadows. This is an example of a long shadow to the upside. Long shadow to the upside means that the buyers are being rejected. So for example, here you can see a concept where we applied two interpretation of candlesticks. The first one is that we have a long shadow. So the long shadow represents that the buyers have been rejected. And of course, they've been rejected by the sellers. And then to confirm, we now come and get a long bearish candlestick. So we have the first reason that the buyers have been rejected by the sellers. So we are trying to anticipate that probably the sellers will outweigh the buyers. And indeed, we get a long candlestick. If this isn't enough, you wait, you be more patient, you get another long bearish candlestick, which confirms to you that indeed the sellers have now outweighed the buyers. So if you took a sell trade here, that would have been a valid trade. So that's a long upside rejection. Here is an example of a long shadow, but this time to the downside. So when you see a long shadow here, we are trying to say that the sellers are now becoming weak and the buyers are taking control. We've also spoken of the difference between long bodies and small bodies. So whenever you see long bodies, we have momentum. When the bodies are small, that means we have very weak momentum. And whenever there is weak momentum, it's not a good time to either buy or sell. At that point, you want to stay out until you find a reason that we have momentum in the market. Because you see, for example, let's just look at this point here. If you look at the behavior of these candlesticks here, they are very small bodied candlesticks. So these candlesticks simply show you that neither buyers nor sellers are in control. So at this point, you don't want to be either buying or selling. All you want to do is be patient at this point and wait for the market to give you a sign that we have momentum. For example, you can see after a long time, we got a long green candlestick, we got another one. So at this point, you can now get into a trade because we have momentum. The key concept with interpreting candlesticks is that you are able to identify whether the market is moving or not. And if it's moving, you're able to spot whether it's moving up or down. So based on this, if you combine it with other technical analysis and your strategy, it can help you to know whether it's a good time to take a trade or not. So I never advise anyone to trade a market that has no volatility. So when you see the market price forming such small candlesticks, I never advise you to take a trade at such a time. Same to this point, same to this point. But a good example, as we've seen here, when we have such a long candlestick, it already tells you that we have momentum. So when you have momentum, there is force for the price to move to that particular direction. So basically, that's how you interpret candlesticks. I hope you've understood. So that brings me to the end of this session.